Welcome to Exploration Radio. My name is Ahmad. Exploration Radio is produced with the support of the Australian Institute of Geoscientists. We are also the official media partner of the 2022 PDAC conference. On this episode, our guest is none other than Rick Rule. He needs no introduction. If you don't know who Rick is, Google him. I'm pretty sure Google was invented just so people could find out about all the stuff that Rick has done. Oh, and if you want to know more about what amalgamated aardvarks are, you won't find that through Google. You just have to listen to this episode. Now let's get on with the show. Welcome to Exploration Radio, Rick.
Thank you for having me on, Ahmed. I appreciate the opportunity to visit with yourself and your audience.
What are you doing with yourself these days? You are quote-unquote officially retired. Are you one of the people that is busier in retirement than they were when they were officially working?
Yeah, I suspect I'd flunk formal retirement. I'm still working quite hard. I've been very lucky in life, Ahmed. That doesn't mean I haven't worked hard, but I've been very lucky. And I'm in the rather unique position of not having to do anything that I don't want to do, but I like to work. The consequence of that is that I've retired from any regulated position. I'm no longer an officer of Sprott, as an example. I've given up my securities licenses, so anything that might cause me to deal with a government agency, with the exception of course, IRS, the Department of National Revenue, is gone.
You can't escape them, so that's a problem.
But not dealing in regulated activities, having things like commercial freedom of speech. I'll be able to say things in this interview that I wouldn't have been able to say a year ago as a regulated person. I've also given up managerial and administrative responsibilities. You know, I used to have a couple hundred people that in effect reported to me. Now I have one employee and I report to her. You met her, Callie, an extremely competent human being. And rather than having her report to me, although I pay her, rather than having her report to me, I report to her. So I've decided at age 69 that I'm not going to do anything I don't want to do. And I'm going to do a lot of what I like to do. And I recommend it to anybody who can afford it. It's a wonderful spot to be in.
Is there a particular reason why you've got to that fork in the road now? It's a bit of a leading question in saying that, do the events of the past 2 years have led you to a point where you want to unburden yourself of these requirements?
Probably I should have done it earlier. When my business was bought by Sprott at the end of 2011, we were entering a very deep and very painful bear market in resources. And I made a pledge to myself, my fellow shareholders, my employees, and my clients that I would see them through the bear market. Now, the truth is I overstayed a little bit. I probably could have stepped out at 2019, 2020, but there were a few tasks left undone. And when I accomplished what I wanted to accomplish, the joys of working within the Sprott organization began to be exceeded by the frustrations associated with maintaining my securities licenses and the restrictions on commercial freedom of speech. And also the administrative burdens. What I like doing is securities research and communication. And what happened to me is I found myself spending 50 or 60% of my time running a business and only 40 or 50% of my time doing either the teaching or the research that I enjoy. The idea that I should, at this stage in life, when I don't have to work at all, be engaged in something that isn't pleasant is stupid, frankly.
Fair enough. So you kind of brought this up. How did the marriage between you and Sprott come about? What was the benefit for that marriage for you guys?
Well, as I started off by saying, the part of the business that's always been pleasant for me is securities analysis, either credit analysis or equity analysis. And as an investor and speculator, it was very easy, given that I was doing a lot of research and paying for a lot of research, to build a financial services firm around that research because I got to use the same research twice. And I had a very good speculative track record as a money manager and as a speculator. As my business grew, the amount of time that I was able to spend doing what I liked, which was securities analysis, fell. And I spent more time running a business.
That's the curse of being successful in some ways, Rick.
Correct. So I was looking around for someone to run my business. And I happened upon a young Canadian investment banker who I had a high regard for, who'd built and sold a financial services business. And I began discussions with him about coming to run my business. And he called me and said, I'm going to have to call off these discussions because Eric Sprott has hired me to run Sprott. I knew Eric very, very, very well. As a competitor, as a friend, as a customer, in every regard. And this young man said very intelligently, now we could continue our discussions about my running your business, but the ownership of the business would have to change. You'd have to agree to be acquired by Sprott. I have long admired Eric Sprott, and I have often thought if I would cast my lot with anybody in the business, given his honesty and intelligence and his naked aggression, that would be Eric Sprott. So from there was probably 3 months of negotiation between Eric, myself, and Peter Grosskopf. Really, very quickly, I decided that I would put my business into Sprott. I would return as much as I could to the part of the business that I enjoyed, and that they would run the business. Not too long after that, Eric decided to retire. And what that meant was that many of the governance roles that had fallen to Eric and I had assumed would be his for the rest of time fell to me. So, I mean, the merger was a wonderful thing. We built a truly spectacular organization at Sprott through the down markets. We continued to invest in our people. We stayed true to our natural resource focus. We stayed true to the contrarian focus. Many other allegedly natural resource money managers suddenly went into, literally and figuratively, drugs, technology. They showed their true stripes, which is to say they didn't have any. We built a business with $20 billion AUM, managing money for over 300,000 investors worldwide. We built a spectacular franchise. I'm absolutely delighted to have been a part of that. I'm still delighted to be, I believe, their largest private client and their largest shareholder. I'm still a director. What I'm not is an employee.
Fair enough. So you kind of touched on this, so we're going to jump around a little bit, but you touched on this, so I want to go down this path. This move out of the speculative market for a lot of investors in North America, particularly the resources industry. Why didn't you go down that path? I mean, it seemed to be that there was an en masse movement, or the speculative money kind of moved out of mining and exploration into marijuana startups and whatever else they went into.
Early in my career, in the aftermath of my first success, I believed that my investing skill set was sufficient enough that I could operate in businesses that I didn't understand as well. And I learned a few painful lessons, which is to say, like Malcolm Gladwell says, it takes you 10,000 hours to be good at something. And I didn't have 10,000 hours for technology and another 10,000 hours for psychedelics and another 10,000 hours for consumer durables. Also, my style as an investor is very much as a value investor and very much as a contrarian investor. And the fact that the hard money moved out of resources, the hot money, I'm sorry, not the hard money, the fact that the hot money moved out of resources and didn't like them made them more attractive to me. Precisely because resources were out of favor, some of the companies 5 years ago had valuation levels that were just absolutely too tempting. When I compared fairly well-run natural resource businesses that were selling at 75% of net asset value with businesses that I couldn't pronounce and would never understand, selling at premiums that I also didn't understand, my decision was fairly simple. I have spent 45 years coming to understand the natural resource business. I'm a contrarian individual, and I spent 45 years understanding conventional financial services businesses. In retirement, I focus my investments on areas where I believe I have a durable competitive advantage, both in terms of knowledge and in terms of contacts. I also have no fear of missing out. If somebody tells me that they bought some unpronounceable crypto token at a mill, a tenth of a penny, and it went to $10, congratulations. I feel good. But I have absolutely no envy about that. I have found that fear of missing out, with the exception perhaps of compound interest, is the greatest foe of the speculator.
This amount of money kind of moving in and out of the industry would have surely changed the speculative industry as well. You've been, I think, really strong in kind of investing in that speculative side of the industry. So how did that side change with the fervor of cryptos and marijuana startups, all of these other things that came about?
So what do you think the industry is worth? What would you pay, Ahmed, for a business that was losing $2 billion a year? Would you pay 6 times losses? 9 times losses? If it was in favor, would you pay 15 times losses? The truth is that the industry is horrifically overcapitalized. That belies the fact that, say, 5% of the issuers generate so much performance that it lends credibility and even sometimes luster to the 90% of listings that are comprised of the lame, the halt, and the blind.
Yeah.
And the fact that crypto might have taken $3 or $4 billion away from the exploration business. The fact that marijuana might have done the same thing, from my viewpoint, is an unalloyed good. The idea, too, that 300 or 400 former used car salesmen that used to disgrace the mining business are now crypto experts, or more properly, pot experts, something where they actually do real due diligence.
Yep.
I think is a benefit to the mining industry. Being rid of those people who have no specific expertise other than separating suckers from their money.
Do you think that it became harder for the industry to raise money during that time because there were other sources?
I think it had nothing to do with crypto. I think it had to do with the extraordinarily poor performance of the exploration business. In the early 1990s, resources were deeply out of favor, and we had a tremendous boom in exploration stocks because we had a tremendous boom in discoveries. Money was spent intelligently. People were recycling the ideas that they generated in the decade of the 70s, when there was also too much capital, but using capital much more prudently. We had these absolutely wonderful discoveries. The consequence of that is, in a fairly weak market with regards to resource pricing, we had an insane bull market in exploration. And the insane bull market in exploration was due to something that the industry hasn't tried for a while. It was called performance.
I think you started off this interview by saying that you now are basically unshackled with what you can say, and you are going to make yourself a pariah if you say things like this, Rick. But I think it's actually it's absolutely true. This whole thing that sometimes you complain in the industry about the fact that money is moving out for all these external reasons. Fundamentally, if we return value to investors, why would investors ever leave, right?
Correct. Absolutely correct. And, I don't want to paint the entire industry with that brush. I tried to say that 5% of the issuers have generated such extraordinary performance that against the 95 that are dross, that 5% has carried the whole industry. If you look across the history of the industry, you find families like the Lundin family. You find people like Ross Beatty. You find people like Bob Quartermain, Clive Johnson, Jim Bob Moffat, these serially successful people who generate such insane returns that year in, year out, billions of dollars flows into an exploration business which loses $2 billion a year. The point of all this is that you really, really, really need to pick your people and pick your places.
Yeah, and I think one of the things that, is this faux pas is that, we always give these industry averages. Yeah, but that's not true for exactly the purpose that you're making, right? Or the point that you're making, which is that, not every dollar being spent is the same. So, so that's a fundamental assumption that we make. But that's not true. Like, if you look at any sports teams or any sports league, right? But almost in certain leagues, almost all the teams have exactly the same money. But but one wins the championship and the others don't. So whatever they are, right? So fundamentally, one is being more efficient in the way they operate or the way they utilize their resources, etc. Isn't that true for exploration industry as well?
Well, listen, since I'm engaged in this sort of rant, which will cause many of the issuers to dislike me, let's go further. Maybe 15 years ago, a young intern came to work for us, and he was very smart. I couldn't keep him busy. And I said, okay, what I'd like you to do now is I'd like you to pull 5 years of balance sheets and income statements from a random group of exploration juniors. I'm not going to tell you what I'm looking for because it'll be too easy for you to find it. I want you to look at the balance sheets and the income statements, and I want you to tell me what is obvious there. Not knowing what was obvious, just giving him something to do and trying to figure out the way he thinks. And after about 10 days, he comes back, he says, okay, I've got it. I know it. And I was thinking, well, this is very interesting because I don't know what it is. He said, in my sample, and admittedly 25 isn't a statistically verifiable sample, given that number of listings, but in my 25 company sample, over 65% of the money raised was spent on general and administrative expense, and 35% went in the ground. Now, in the private side of the business, if you and I generated a prospect and we sold it to tech, they might give us a 12 to 15% G&A override. But in the TSXV Junior Resource Index, at least with a subset of 25 randomly chosen, 65% of the capital raised didn't go in the ground. So when you talk about the fact that money is spent differently, money is spent very differently than most investors think. You
Correct.
have, not surprisingly, serially successful people like Ross Beatty, who we used to joke throw nickels around like manhole covers, who were extremely efficient spending money.
That's
But
right.
they were also able to raise and deploy money at a scale where they generated more exploration expenditures relative to general and administrative expense. If you look at the industry as a whole, though, the publicly listed junior exploration industry, it's unsustainable with these levels of G&A.
Just as a complete aside, Rick, like during my research project, I did kind of something similar. So, at one point I went and did some graduate research. And I came to the same conclusion that actually the way, you could very easily identify companies that behave differently based on how they're spending their money.
Correct.
And, that behavior has a direct relationship to, essentially the success they have. Now, often it's not, like sometimes it's not discovery success, but just the ability to, turn over projects and to move to better kind of projects, etc. Like that's exactly what you kind of want to see. And so, on the opposite end, you see the behavior, which is companies spend money badly and spend it on the same, like portfolio projects over a decade. And so you got to argue whether that's the best money being spent or not.
I don't think there's any argument.
No, that's right. So here's an obvious question to you: if what we are saying seems so obvious, how come it's not a general understanding across kind of the investment space?
I think that not just in mineral exploration, but in equity investing in general, that the last 40 years have been extremely benign. The period 1982 to 2022 has been extremely benign. We've lived through a real boom, a demographic boom, with the baby boomers coming of age and earning as opposed to costing.
Yep.
That's over, by the way. We're dying now. But also a period of declining real interest rates, which meant lower cost of capital, which meant higher share price valuations. But we also, earlier in this 40-year cycle, benefited from increasing participation in the labor force by women. So we accessed more intellectual capital than we had. Internationalization, globalization, free trade, a really benign time. We have been through probably the most benign period in human history, and it's made us very, very, very aggressive as investors. It has taught us to value narrative as much as we value arithmetic. Now, I happen to believe that the wind is coming out of all those sails. I don't think that you can that you can lower interest rates too much below zero.
That's all right.
I see economic nationalism reducing the benefits of globalization. The benefit that we saw during the Reagan years of the early 80s with the reduction in the growth of government. By the way, they never shrank government, they just reduced its growth. That's over. Around the world, social rents and regulations are on the increase. So that I think that the period that we're heading into is going to be less benign than the period that we've been through. The only thing that gives me hope, really, for the next 20 years will be the convergence of various technologies. The fact that we still live in a culture where, 6 pimply-faced high school kids can commandeer a garage in Sunnyvale, California, and out pops Google. What's cool now for the next 20 years, I think, we're getting far afield from mining, we're talking in a very general sense. I think those 6 kids are likely going to be in Mumbai or Lagos or
That's right.
Kinshasa or La Paz.
Yeah, I think that's a fantastic point in the sense that you kind of give the macroeconomic view. It's also that kind of 1980s to 2000s kind of period. Also coincided with the largest amount of people kind of moving from rural setting to urban setting.
Yes.
So the consumerism, I think, in that phase was obviously the highest as well. And you just have to look at kind of if you just look at the amount of products or technologies that was developed pre 1980 and then from 1980s to kind of the 2000s and 2010. You can fundamentally see that we completely blew apart that whole space.
Isn't it ironic that at the beginning of this epoch of prosperity, a communist, Deng Xiaoping, said, "To become rich is glorious." Now that the world has become rich, the head of the World Economic Forum says, "You will own nothing and be happy about it." There's probably nothing that speaks to the juxtaposition between the creation of wealth and the destruction of wealth. than the paradox evidenced by those two figures of speech.
And you make a good point in the sense about the importance of narrative during this time as well. What's the Silicon Valley, like fake it till you make it kind of thing.
In exploration, the hope that speculators have, while it's admirable in one sense, it's so naive. I mean, probably 1,000 people have said to me, in some vainglorious attempt to keep some piece of junk stock, Rick, if the price of gold goes up, what impact will that have on amalgamated aardvark explorations? And I'm forced to say, sir, amalgamated aardvark is looking for gold. They don't have any gold. So realistically, if the price of something that you have none of goes up, it doesn't have any immediate impact on your fortune. It might have an impact on the number of naive speculators that they can hornswoggle, which is to say it might make the share price go up. It'll have no impact on the fundamental value. That's what I mean about the exploration business, at least the lame, the halt, and the blind part of the exploration business, being funded by hope and narrative as opposed to science and arithmetic.
Rick, you make this point, like because you've had this career, you've obviously seen this changing tide, like you said, the narrative over the arithmetic. Do you think it's harder for you to find investors if you are more of the arithmetically driven kind?
No, I mean, I've learned how after 45 years to find investors, and that's by not trying.
Yeah, well, success is usually a pretty good way of attracting them.
But teaching, I mean, one thing is I have a reputation now, and it's ironic now that I won't accept investors. I just invest my own money. Now that I won't accept investors, thousands of people, literally thousands of people, want to invest with me, which is hugely ironic.
Yep.
But the best people in the business can always raise money, even in the worst market and even in bad times. In 2014, 2015, if Lucas Lundin would have said, Rick, I'm sorry, but I got to get you up at 3:00 this morning because that's the only time I have. And I want to take you through something I'm doing right now. Man, I'd have my alarm clock set for 2:15 so I could have a cup of coffee ready. So at 3:00 in the morning, I'd be ready to listen. The best people will always be able to raise money. And backing the best people in the worst time is the best speculative strategy. In a good market, the Lundins can raise money at 2 or 3 times NAV. In a bad market, they have to raise money at half NAV. The worst markets are the least risky. The best markets are the most risky. It's a function of price.
Yeah, and I think, I mean, it's an interesting point that, people think that when the markets are hot, you have less risk. Well, actually, like you're saying, I think you have far more risk because now, if you're raising money or you're capitalized at a certain point, for you to have to maintain that capitalization or that return, it's even harder from that point.
Ahmad, what a bear market really is? It's a sale.
Yeah,
if you were going to buy physical goods at a shopping mall, it's winter right now. So let's say, you needed a new coat and you walked into a shopping mall and you expected to pay, I don't know, $300 for a coat. If you saw a coat that you thought was worth $300 selling for $700, you'd be furious. You'd leave that store in a huff. If you went across the aisle of the shopping mall and that $300 coat was on sale for $180, you'd think that's great. Yet, if you own a share of stock for $3 and the stock falls to $1.80, you're pissed. If the stock goes from $3 to $7, you're excited and you buy more. It's the same piece of paper. People treat financial aspects differently than they treat physical assets. Some people will spend a long time researching the purchase of a $10,000 used car, and they'll buy $10,000 worth of stock on a whim. Got a hunch, bet a bunch.
Yeah, so there's 2 things there that I guess I want to kind of dig into. One is this concept of narrative, right? So you've created this narrative around, I mean, look at crypto. I think like cryptocurrency is, I think, one of the best narrative-driven things around right now. The aspects of, kind of the get-rich scheme, it has aspects of pyramid schemes, it has aspects of FOMO, it has all of these things. Mm-hmm. And you can see how they're all like, manipulating that to try to get people in. So your point that, like, why do people, my answer to your question about why do people buy a $10,000 speculative stock and don't, go out and buy a car for $10,000 is probably because the narrative around that stock is very well constructed. Maybe car makers could do better at constructing the narrative around the car as well.
My only point with the car is that people spend more time studying a $10,000 car than they do a $10,000 stock purchase. I would agree with you that the margins on automobiles are less, so the best salesmen are drawn to stocks. I remember the late great Murray Pezim, one of the best promoters of all time in the 70s, said that his materials cost, which was paper, was at that point in time $400 a ton. And if he could paint a dream on that piece of paper and sell it at some premium to $400 a ton, it was all margin. So the best salesman in the world, of course, will be drawn to a product with literally infinite margin.
Correct. Yeah. And so the other point I wanted to make about your thing is around the concept of valuations, right? So, like if you're a gold exploration company and, the price of gold is going up and down, to some degree, it's largely irrelevant what impact that should have on your, company valuation, really. If you understood the development cycle and you understood the timeline of how things take to like find and then develop and all of that stuff. One of the things I think maybe that's is lost a little bit is the ability of the money side of the industry to understand valuations or what's an appropriate valuation and what's not an appropriate valuation.
The money side of the industry, if you're talking about the investment bankers, have a positive disincentive to communicate
Correct.
the math. Their customer is the issuer, and their job is to raise capital for the issuer as efficiently, in other words, as expensively as possible. If an investment banker went out and said Amalgamated Aardvark is selling for 4 times its net present value, in other words, the thing you're paying $1 for is worth a quarter,
yep,
they would earn no fee.
That's right.
So the financial services industry, at least on the sell side, has a positive disincentive to educate their customers around arithmetic. On the buy side, you have a very different circumstance. And the most successful buy side investors are investors who pay attention to their downside before they worry too much about their upside. That isn't to say if you're buying an exploration stock that you're going to buy it at a discount to net present value, because arguably there is no net present value. You have to understand risk-adjusted prospectivity. You have to understand what the value proposition is. You, in exploration, have to do a risk-adjusted net present value calculation around answering a series of unanswered questions. What's the target size? What is the probability that the target can grow? What is the method by which you cause the target to grow? Will the target extend to the third dimension? In other words,
right.
What will drilling prove? There's a whole series of unanswered questions. And when an intelligent speculator is participating in exploration, the question that he or she should be asking management goes like this. What's the most important unanswered question around your property? How can we gain more knowledge about the property that will cause us to better be able to value the tenement? What is your target? And how did you develop your thesis? Was your thesis developed as a consequence of trying to hornswoggle money out of me? Or did it come about as a consequence of facts on the ground? How long will it take you to get me a yes or no answer? How much money will it take you to get me a yes or no answer? Do you have that money? Or if so, how will you get the money? Because if you don't get the money, you can't get me the answer. It's worth nothing. Probably, Ahmed, over 40 years asking that question literally thousands of times, probably 80% of the respondents have said, oh, well, I never thought of it that way. In other words, 80% of the people that I've talked to in the exploration business didn't understand the exploration business. To them, the most important unanswered question was, will I still be drawing a salary from this company in 18 months? And while I could understand that that's important to them, I don't give a damn. What I'm interested in is de-risking a thesis around a property. So it's a process of answering a series of unanswered questions. The issuers will tell us that this is an asset-intensive business, but that's hokum. 1 in 3,000 mineralized anomalies became a mine 50 years ago when I was in university. The number's worse now. So if you think of it as a physical capital business, you're crazy. It's an intellectual capital business. It's like biotech or algorithms.
That's right. It's an
in
IP-driven
software.
business, really.
It's a
right?
knowledge business. It's answering a series of unanswered questions. And if you understand it differently than that, you're going to lose money unless you are a good enough social scientist or a good enough communicator that you can monetize a narrative against a naive population of hopers.
I think this, yeah, like it's interesting why you say that, because the narrative side of thing, like your point that if you are a company that doesn't understand these kind of exploration fundamentals, what is your actual, what is your game here? And I would agree with you that I think a lot of people in this game don't quite understand, exactly what it is. And you can see this behavior when people look at, we're talking about exploration, but you can see this behavior when people look at exploration. The concept that often, people argue, like, what's the value of an exploration project, or what's the value of this company? I just think that's a wrong question to ask, right? The question you should be asking is, what's the quantum of money required to get to the next logical decision point? And does the company have that money to get there or not? Or, like, if it's going to cost you $10 million, is that $10 million going to completely blow up the company? If it does, then you're probably in the wrong kind of property or wrong asset or whatever you're in.
Well, I would argue a little bit that you need to understand your downside. One of the things I like to do with issuers is say, if you were to liquidate the company today, if you were to sell your exploration projects to another exploration company, what could you get for them? What's your company worth? Now, I'm not suggesting that I should get companies that are in the exploration phase at a discount to net present value, but I do want to know what my starting point is. The second thing that I want to know when you're talking about a $10 million exploration program is I want either the CEO or the exploration manager to tell me what the earliest indications that they're wrong is. Because if you can disprove, if you've raised $10 million and you can disprove your thesis,
why would you spend? Yeah, exactly.
There's no reason at all to spend the next $8.5 million. But issuers do it again and again and again and again. And I go back to these guys and say, so tell me, did you deliberately drill your worst idea first? Is that why you spent the whole $10 million? Having them understand what constitutes failure at the same time that they're able to tell you what new question a yes answer will engender allows you to understand the intellectual foundation of the company. It allows you to understand how they use the intellectual capital, which is where all the value is, to develop the physical capital.
So this concept, like what you're talking about, how companies spend money, how much of that do you think is driven by investors?
None.
Really? Okay.
It used to, during bear markets, it's driven by investors, but in markets like these where Schlepp, Schmuck, and Schmo can raise $2 million if they pay enough commission. It's entirely driven by investment bankers and by issuers. The industry is hopelessly overcapitalized.
Yeah. I think it's an interesting point, because I often wonder whether maybe this is not so much for exploration companies, but particularly for mining companies, their ridiculous behavior during the boom cycles. I wonder how much of that is driven by investors. Because like investors at that point want as much value in the company as possible.
Well, not value. When they buy in the narrative, they want the company to monetize the narrative, even if the narrative is wrong.
Correct.
I don't know that this is true, but I have been told that the components of the XAU as a group, the index, in the period 2000 to 2010, when the gold price increased from $250 to over $1,500, shrank cash flow per share. Now that took skill. If it's true, that took real skill. They made insane acquisition decisions. They made insane capital allocation decisions. They let the costs go crazy. But if you think about a circumstance where where you issue so many shares and spend money so foolishly that your free cash flow per share goes down in a period where the price of the commodity that you're selling increases sixfold, that's an impressive achievement.
Yeah, that's pretty hard to do. So if you're doing that, man, you're really doing something good or bad there, or however you want to classify it. And so the other point that I wanted to get back to, which you made earlier, was around the narrative that a lot of these companies utilize. And personally, I find it a little bit interesting when we kind of have the the woe is us kind of mentality about our investors don't like us, because the point you made around that, like the majority of these companies are kind of working on the model that as long as you can keep selling the narrative, you can keep getting investors in. But fundamentally, if you broke it down, that whole logic is built around trying to get the next sucker through the door, and when one sucker gets
Correct.
burned, they leave. Eventually, you're going to run out of suckers at some point, right? Or they're going to be a diminished group of suckers that you could probably keep utilizing.
I think the industry needs to prepare itself for that eventuality.
Mm-hmm.
I mean, if what we're doing is selling narrative, here's an offer. I'll tell all your viewers who've lost money on junior mining stocks, if you send me $10 a year, I'll tell you that gold is going up. You can have the narrative for $10 a year, and it'll cost you a lot less than your securities portfolio if your securities portfolio is based on that narrative.
Yep.
Narrative should be free.
Mm-hmm.
I saw a 44-page deck the other day around a $5 million raise, and the 44-page deck was all about the gold price. Not all about the gold price, but 20 pages of it was about the gold price. This company didn't have any gold. And then, interestingly, some of it actually had to do with the exploration thesis, which I did find interesting. But a 44-page book for a $5 million raise, I don't know how much money per page that is, but it seems to me that if they had something viable to sell, that they could have explained it to me in 8 pages.
Yeah, that's hard. Man, we're not going to make any friends here, if you keep talking about this. But, I think...
What do I care?
I think this is the point is that, personally, I don't really mind either, because I think we should talk about these things, because, people
Sure.
on the other side of the fence are talking about it. So if we put our head in the sand, eventually, we will come to an adverse outcome, and then people are going to go, well, how did we get here? Well, it was pretty clear how we got here, it's just that nobody wanted to do anything while we were getting here. Even this whole thing that you talk about, like the 44-page booklet, and 25 or 25 pages are about the gold price. Can you look at any copper exploration company that doesn't tell you their view on the copper market and it's like, man, what is your asset? How good is your asset? Can you tell me about that? I don't want to know about your projections about copper price or any of this stuff.
When people hear me say this, they say, well, Rick is so negative. I'm not negative at all. The industry's made me a fortune.
Yep.
I just don't believe that I should pay somebody for narrative. I believe that I should pay somebody for hard work and results.
Mm-hmm.
Nothing particularly negative about that. If you asked me a question about what are the habits, what are the traits of serially successful people in the mining business, you'd find me to be a raging optimist.
That's because you choose not to work with, the charlatans, let's say.
Sadly, I've associated with both, but never on purpose, of course, with the charlatans. But some of them are really, truly superb salesmen. So,
yeah, and I don't mind. I think, we need all of these type of people in the industry. I don't mean to say that, if you can make a good living selling a story, good on you. I think it's great that you're doing that. But let's not then complain about the outcome that we get to when we have too many of these people doing a certain thing.
One of the things are, mercifully, the industry has some people who are hugely commercially and technically competent who can also sell.
Mm-hmm. Yeah.
I remember Bob Quartermain coming to sell me on Pretium when he first started it. Now, it helped that he'd made me a fortune on Silver Standard.
Mm-hmm.
So he could begin the selling process by saying, I told you so.
Yeah.
But the story was very simple. The story was the mineralized complex at, sulfurettes, all that, had 100 million ounces of contained gold. It was just very low grade.
Mm-hmm.
Their third of the deposit was probably worth a third of what Seabridge's was. And their market cap was non-existent, and Seabridge was at $500 million.
Mm-hmm.
So on a valuation basis, they had more upside than downside, but more particularly that if you had a mineralized universe of 100 million ounces, there was probably some area where there had been sufficient rock preparation to generate a concentration of mineralization. And it just so happened that there was a structure called the Bruce Jack Fault that had 5 different holes in it that exceeded half an ounce per ton. And he said, so what I have is this big, big, big mineralized system, a 14-kilometer long structure that could concentrate it, and 5 pierces that demonstrate the potential of what I'm trying to accomplish. I believe that with 20 drill holes, I can determine whether or not I can develop a 1 or 2 million ounce high grade deposit along the Bruce Jack Fault. It took him 3 minutes to explain that thesis to me. He's an extremely good salesman. Mm-hmm. He could say, I told you so. But the truth is that what he was selling was so simple. Mm-hmm. He didn't have to tell me that the gold price was going to go up. He didn't have to do anything like that. And, I've experienced the same thing with Ross Beatty. Ross Beatty has been serially successful. I've participated in 14 companies with Ross, and I think I've enjoyed 12 10-baggers. Mm-hmm. And his story is always really, really, really simple. This is what we're trying to accomplish. These are the steps to get there. This is how long I think it'll take us to there. This is what I think can go wrong, and this is what I need you to do to help me. And then, of course, the greatest of all, Robert Friedland, who could absolutely, if he ever wanted to, sell a lie. He literally could sell icebergs to Eskimos, but he doesn't have to. He's been the most successful explorationist of his epoch. A superb salesman. His cost of capital is always low, but he's always delivered.
Yep, that's right. So we can't have this discussion around investing in exploration or anything like that without talking about failure. Yeah, like what's your appetite for failure? You obviously have to have one if you're going to play in this game.
Huge. Most exploration decisions are mistakes. You have to play the game hard enough and hopefully with private placement so that you get some warrants so that your winners amortize your losers. Mm-hmm. The end result of most exploration decisions is a 15, 20, 25, 30% loss. If you play the game 20 times, you have to expect to lose 12 or 13 of those times. You have to expect to break even a couple times, but hopefully you get a 10-bagger. Mm-hmm. And a 10-bagger with a warrant becomes a 15-bagger. Mm-hmm. And a 15-bagger amortizes a hell of a lot of sin in the rest of your portfolio. Mm-hmm. That's the way the game is played. I've said on numerous channels, and people shake their head in wonderment, most of the wealth I now invest sensibly, I got by speculating. Some would say nonsensically. And the truth is that most of that wealth was concentrated in a fairly few decisions. Companies that gave me 10-to-1 returns, 20-to-1 returns, 50-to-1 returns, whatever they were. Almost every 10-bagger of my life, with maybe 2 exceptions, took 5 years to achieve. And almost every one delivered me at some point in time during the time I held it, during the 5 years or 6 years that I held it, a 50% decline in share price. Mm-hmm. So you have to have enough courage of your conviction. In other words, you have to have a deep enough understanding of the value of the proposition that you're not unnerved by the price. Mm-hmm. You have to have the patience so that compounding, a series of yes answers, can give you a 10-bagger, and you have to be tenacious. Mm-hmm. You absolutely have to be tenacious. I've done a lot of work on the genesis of my 10-baggers, in hopes for more.
Yeah, that's right.
And, what I've learned was most of them originated in horrific markets, meaning I was able to get great assets with very, very, very low entry charges. Mm-hmm. Most of them did nothing or went down during the first 12 to 18 months of my holding. Mm-hmm. Almost all of them were as a consequence of associating myself with very, very high quality people. Mm-hmm. Almost all of them required at least a 5-year hold, and all of them experienced volatility that would remind the average person of a rodeo. And you have to be fiscally and psychologically rugged in order to play that game.
What you're saying about, kind of the volatility and how, like how these stocks or equities kind of perform or securities perform. Would it be appropriate to say then that the market capitalization of these things probably is not a fair valuation of what the underlying asset is at all times? Would it be a fair thing to say?
Well, I think further than that, I think it's, the information around price only is valid if you have some estimation of value.
Mm-hmm.
The share price is a floating abstraction.
Yeah, that's right.
That's really what it is.
I mean, the share price is purely how much money you can raise at a certain point of the cycle, or things like that, right? That's really all it's for.
That's from an issuer's point of view. From a check writer's point of view, it's just a floating abstraction.
Mm-hmm.
Money is made on the delta between the value and the price,
Mm-hmm.
or the prospective value and price. People pay slavish attention to the price.
I know.
And price information is worth nothing if you don't have an opinion of value.
I know. I mean, the reason why I asked this question is because this is one of the things that I find quite frustrating when people like often will kind of come and like like talk about things, where they'll say that like the price has gone up or the price has gone down, and like it's irrelevant. Like like is the underlying asset that they have, or like you said, is the underlying understanding getting to a point where we know that there's actual value, or we know there's no value? Like, are we moving closer or further away? And people go, but the price is going up, so the project is getting better. And you're like, no, the project will still be terrible. It's just that that's a pure reflection of where people wanted to put their money in that day.
It's a truly insane way to think.
Yeah.
If there has been no change in the value of the company, and the price has doubled, arithmetically, the company is precisely half as attractive.
Correct.
If there has been no change in the affairs of the company and the share price falls by half, arithmetically, the shares are precisely twice as attractive.
Correct.
Most people don't have enough courage of their conviction to believe the narrative unless they're getting support from the price action.
Yeah, and I think that's the reason, right? It's because in void of actually having some real understanding, you need to augment it based on some metric, and the metric is share price.
It sounds really hubris-ridden to say, but those people are my normal and natural victims. It's not that I sell them anything. It's just that if I own a dollar stock that goes to $4 and not much has changed with the affair of the company, when all the people come in that are attracted by the momentum, I allow them to buy my stock.
That's right. Yeah, exactly.
They exist to me as a source of liquidity. Similarly, if there's a stock that was attractive at $4, but for some reason the price falls for $2, and people don't spend an awful lot of time familiarizing themselves with the affairs of the company, but rather than that, let the share price shake them out, they're also a source of liquidity.
Mm-hmm.
I sort of believe, in one sense, that you do what's the easiest in the market.
Yep.
If the market is predominantly populated by sellers, the easiest thing to do is buy, and you should do it. If conversely, if the market is predominantly populated by buyers, and the easiest thing to do, the place where there's less competition, is on the ask, then you should be a seller.
Yeah, that's right. Maybe we're being a little bit, like maybe we're drinking our own Kool-Aid here a little bit. But, like I sometimes think that, this level of understanding doesn't quite make it all the way through. Like, for example, like sometimes you look at projects which for all intents and purposes have held exactly the same project value. And yet you look at, the capitalization and take that as their market value. It will go from being, $1 billion down to being $50 million. But the project value was probably always around 200 million. And so people get really hung up on this thing where, people inside the company as well as, people outside, particularly like I spent a bit of time with private equity, and I think we sometimes got a little bit too hung up around the market value of products. It's like, what's the actual asset value here that we should be transacting on?
I think the market value is only relevant if it varies substantially from the asset value.
Yeah, exactly.
I really truly believe the market value is a floating abstraction. I think it was Charlie Munger, Buffett's partner, that said, in the very short term, the market is a voting machine. It measures sentiment. In the longer term, the market's a weighing machine.
Yep.
Money is made by discounting the way people vote in favor of what an asset weighs. And I think that's exactly correct.
Yep. And I think, we talked about this in the pre-interview where, like some of the other, I guess, metrics of valuing things on the market, like P&E, ratios, all of these type of things that have been applied in this industry, particularly in kind of the exploration game, are just completely irrelevant. They don't mean anything because, you're not, you're trying to use something that works for one asset class and trying to apply it in an asset class where it has absolutely zero relevance.
Think about this. I mean, think about how relevant PE might be when the reserve life is 3 years. There's no sustaining capital investment because the ore body isn't going to last. Free cash flow is very, very high. The idea that you would value a 3-year mine life at a 15 PE when your terminal value in 3 years is zero is the height of insanity. And I see it all the time.
Yeah, I know. And it just, I think, like, even simple things like, like if you fundamentally understood any mine being built, it's basically a debt business. Like it's really around how, like the payability is probably a far more important metric than anything else. And sometimes people, they just go, it has, this is how much money it's going to make. And it's like, but is it actually going to make the money to kind of pay it back in a time before the resource actually runs out? Like what is the true years of profitability we're actually going to have in this asset?
Certainly 30 years of being a lender to the mining and oil and gas business has made me a much better investor. Understanding the net present value and understanding the probability of the narrative as juxtaposed to the time value of money. Understanding that the worst piece of debt on any balance sheet is better than the best piece of equity. The conservatism that's involved in being a debt investor, because you can't confuse yourself with the upside because you don't get it, makes you a much better equity investor, or at least it's made me a much better equity investor.
Yeah. Is that because you understand the downside essentially much better in that sense?
I also understand the construct of the upside. I mean, I understand, first of all, that the word could is not collateral.
That's true. It's true.
If you give me, as a decent salesman, I'm not a great salesman, but I'm a decent salesman. If you give me the use of the word could, should, or would in an unrestrained fashion, I can sell you anything.
That's right. Or potential. Yeah, the most overused term.
It causes people to take loss of probability. Life is not about certainties. It's about probabilities. It's about the juxtaposition of probabilities. And the wonderful thing about being a lender is it focuses you very much on probabilities, and it gets you to discount very aggressively could, should, and would. It's interesting. It's interesting too, if I might bore you with this detail.
No, go away. Go for it.
Investors and speculators need to pay more attention to debt. The results that Sprott as a corporation got in the period 2011 to 2019, which saw the TSXV resource index, the junior resource index, decline by 88%. The Sprott lending business conducted on balance sheet in Sprott generated a 15% compound annualized internal rate of return. Now, 15% annualized compound internal rate of return is a very handsome standalone rate of return. But when you juxtapose that with an 88% loss of principal, it will tell you the benefits of a realistic approach in both bull markets and bear markets. If you give up hope and focus on return on capital employed, you will do better in thick and thin.
So I want to hark back to something that you said around probabilities. So do you think that people understand the risk profile associated with probabilities? I mean, we can't have this discussion without kind of talking about risk in some ways, right? Because a large part of like debt, like when we're talking about debt, and this kind of maybe the link to it, you really need to understand where your risk lies and where it doesn't lie when you're getting into the kind of the debt business or the lending business.
I think that speculators rely on hope, which is why they lose money. There will be comments in social media around this discussion where people said, Rick always talks about risk. He always talks about probability. He always says the same thing, as though, first of all, the facts don't change. And my job is to make them feel good about their stupidity. Neither of those are true. I don't think that speculators, the unsuccessful speculators, which constitute 80% of speculators, I don't think they understand the concept of probability. I think, too, that too often they're motivated by simple declarative statements, which is to say they confuse the promise of certainty with the existence of certainty.
Yeah, that's a good way to put it, actually. That's a very good way to put it.
And I would suggest the fact that you would like certainty is interesting but not relevant. What you would like is much less important than what you might be able to have. What you have is a series of probabilities, which are either good or bad. but you almost never have certainties. There are some certainties in the market, but they require long time horizons. Here's a certainty for you, an absolute certainty. If you have a commodity where its consumption, its utilization is essential for the material well-being of mankind, so that demand for the commodity is assured over a period of time, and the industry-wide selling price of the commodity is less than the cost of production, which is to say the industry is in liquidation, that commodity price will go up. That is a certainty unless society invents a substitution for that commodity.
Or doesn't require it anymore, right?
Yeah, 3.5 years ago, when nobody wanted to own uranium because no uranium companies were making money, there was actually a certainty. It was an extremely unpopular certainty. But the certainty was this: if the price of uranium didn't go up to the incentive cost of production in 6 years, the lights would go out. It's that simple. That's the certainty. Yet, because there was no certainty as to the time frame, people preferred to ask themselves questions where the answer began with if, where there was no certainty, than asking themselves a question where the answer began with when there was no time certainty. I mean, this is ironic behavior. The very, very, very few subjects where there is certainty in outcome, there usually isn't certainty in terms of time. And it is precisely in those circumstances where investors shun certainty because they don't like it.
The relevance of time frame, in things like commodities, I think you can play this game in commodities because you can always have a fundamental view on whether a society will require a commodity more or less, or will be substituted, or what we will do with it. We talked about the coal story in the pre-interview. I mean, I think it's a classic example of it.
It is, and
like we were supposed to be phasing out coal, yet the last couple of years has seen a huge intake in coal.
Well, there again, there's another certainty in terms of 10 or 20 years. Many speculators pay attention to the big thinkers' narratives. In other words, they get their economic advice and their advice around physics from the noted scientists Angela Merkel and whatever that young Swedish woman's name is, and they allow the popular narrative to distract them from the facts on the ground. The facts on the ground are that 1.2 billion people on Earth have no access to electricity at all.
Correct.
Another 2 billion people on Earth experience energy poverty, which is to say either inefficient electricity or electricity that's too expensive for them to afford. One of the great achievements of humankind in the last 30 years has been the incredible upgrade in the living standards of the bottom half of humanity. And mercifully for us, that's continuing. Those people want to live like you and I live. And increasingly, thankfully, they're getting the means to do that.
Just to add one point is like they want to come up, but we don't necessarily want to go down either, right? So so that's I think a key point as well.
Your consumption of electricity is going to increase, and not just because of automobiles. So is mine. But most importantly, the consumption of electricity in the bottom half of mankind is going to increase, which means that we need all forms of electricity, and we need them to be affordable. The second thing about coal that people forget is that emerging markets people are being asked by the big thinkers in the world to shoulder the burden. People say that the increase in carbon consumption by China and India is unsustainable, when their consumption on a per capita basis per person is less than 20% of ours, and where the historic coal loadings were contributed by Western countries. The only way that carbon loadings are going to approach the levels suggested by the Kyoto protocols is a drastic decline in living standards in developed countries. And it ain't going to happen. In Canada, everybody says we have to go to a low carbon environment, and you have to pay for it. The idea that the Indian peasantry is going to sacrifice their upside for the well-being of an SUV driving suburban Canadian, well-intentioned green person that they are, is nil. But
let's not forget they recycle, Rick. So so they're doing their part, right?
Of course.
These kind of fundamental things, I think, like for example, like the large percentage. most of our life currently, I mean, this whole interview is being done largely because of the aspect of cheap electricity that we have, right?
Yes.
You look at
Yes.
the medical care that we can provide, the way we travel, the way we do, the way we communicate. All of these things are largely built on a cheap source of electricity. Now, fundamentally, if you take the view that coal is now, like it's on the nose, and people don't want to go down that path, but then you also then have to do the analysis to say, well, what is the commensurate kind of replacement that's going to come in that's going to allow us to keep producing electricity cheaply, because otherwise we couldn't maintain the standard that we can. And I think, like in your logic also, I kind of look at it, the coal story. We didn't talk about this in the pre-interview, but yeah, if there is this move out of coal to a point where like the value of coal assets is low, then that actually makes it more appealing for people that are looking to produce a cheap source of electricity, because now you don't have to pay the premium that you did a couple of years before.
I'm willing to believe that massive investments in the grid and addressable grid technologies and massive investments in nuclear power and massive investments in intermittent alternative energy
Mm-hmm.
means that we will be much less coal dependent 30 years from now than we are now. But that leaves the next 30 years, doesn't it?
Mm-hmm.
We've seen the outcome of early experiments. Germany would be a classic example. Germany decided post-Fukushima to scrap their nuclear fleet. Two consequences of that. One, electricity bills in Germany have gone up by 500%.
Yep.
At the same time, ironically, that German consumption of dirty lignite coal has skyrocketed.
Yep.
There are no free lunches. And ironically, of course, Germany is also importing a lot of energy from France,
Mm-hmm.
where it's generated from nuclear.
Yeah, that's why. Yeah, exactly. Yeah.
And we see, I mean, the idea, as an example, that Germany, as rich as it is, could be powered by solar power when it's so far north where the sun doesn't shine.
Yeah, I know.
I remember Ontario Hydro for a while was paying 80 cents a kilowatt hour for rooftop solar in Toronto. Why on earth, that far north, would you want to run or attempt to run a grid based on a scarce resource?
Mm-hmm.
And of course, what happens at night?
Yeah, that's hard.
Relying on solar at night is a bit of a challenge. Now, when you make massive investments in the grid and the grid becomes addressable, where people are paying a premium to buy peak time power,
Mm-hmm.
and they're buying off time power at a discount and hopefully storing it in a $40,000 battery wall.
Yep.
All of a sudden, the grid itself becomes the battery.
Yep.
And then all of a sudden, wind and solar and all these things begin to make real sense.
Yep.
But that period is way, way, way off in the distance.
And this is an important point that you kind of make, is like the timeline of things occurring is something that like you have to take into account as well. Like we can't just turn the Titanic around in 1 year. It's just not going to work that way.
Glencore recently bought a partner out of a tier 1 multi-decade coal deposit, a 30-year coal deposit,
Mm-hmm.
and they bought them out for 1.5 times cash flow. Now, you could say that the cash flow that happens from 20 years from now has no net present value, and it becomes a stranded asset. So what? 1.5 times cash flow for a 30-year reserve?
Yep.
That truly is the triumph of narrative over arithmetic.
Yeah, that's why. So we kind of keep coming back to this kind of concept of like narrative winning out over arithmetic. Do you see? So in a world where like we kind of have all of these opinions being put out there that the cost of capital is going to go up. Like, do you think that like part of the reason why we are stuck in this loop is largely because the whole aspect of money never being cheaper than it ever is now. Like if that environment changes, do you see that shift occurring in the way that the markets work?
I sure do. I sure do.
I mean, I think it has to, right? I mean, if money becomes more expensive, like you have to change your story.
I believe we've been through an extremely benign economic circumstance.
Mm-hmm.
And while I believe that 20 years from now or 25 years from now, the world will be better than it is now,
Mm-hmm.
I believe we have a reckoning. I'm not suggesting that we go through a depression or a recession, but I do suggest that after a 40-year period of declining interest rates, you can't take them too far below zero for too long. I mean,
Yeah.
think about the reality of negative interest rates. That means that you, as a young man, work hard and save, and you decide that you are going to give me the benefit of immediate production consumption, not you.
Yep.
So you lend me the money, take the credit risk. You forced all consumption in favor of me, and I give you back less money than you gave me.
I know.
Now, how much sense does that make?
I know. Well, I mean, like, how sustainable is that in the long run, right? Like,
It
like
is
clearly someone's going to run out of money.
any system that subsidizes spending at the expense of savings
Yep.
will ultimately generate a reduction in capital stock and will be self-correcting.
Yep.
And that self-correction will be interesting. It's something that the world's going to have to face. I'm not going to face it because I'm extremely well capitalized.
Yeah, that's right.
And if you're a capital provider, the idea that capital is becoming more expensive is a very good thing.
Yep.
I'm at age 69, I'm not a capital consumer anymore. I'm not raising money for anything. I'm allocating capital to things. So a circumstance where capital becomes more scarce, and as a consequence, where the rents on capital are higher, benefits an old fat guy like me. It doesn't benefit a capital consumer, a younger person, an issuer.
But also, like, fundamentally, if capital becomes expensive, then people have to think harder about how they go raise capital, and then investors think about how much they want to actually capitalize things. So so in that environment, surely our performance will increase. Like you would think logically it has to increase.
Correct.
Or we are all dumb. That's the only other outcome out of that.
Well, ultimately, history takes care of dumb people, even collectives of dumb people. The outcome isn't pretty, but that happens.
Yeah, that's right. Yeah, that's right. I mean, eventually there has to be that correction at some point.
Weimar Germany was a very dumb circumstance. They decapitalized Germany. And the result of the collective stupidity of the German people was a guy named Adolf Hitler. There are consequences of being stupid.
Yeah, that's
and they're grave.
I mean, I have to say, Rick, like, we could keep going on this forever. We have to get you back on the show at some point, because
I look forward to it. It's a delight to have an interviewer not say, when will the price of gold go up? It's nice to have discussions that are actually of value.
Yeah, like, I don't know about you, like, like, I obviously don't have the level of experience you do, or have seen these kind of cycles, but like, I often kind of sit in these and like, these kind of discussions around like, how to improve the industry or something, and people just go, well, we just got to improve the commodity price, and like, that is the last of our worries at this point. There's a whole lot of capital inefficiency, performance inefficiency, all of these things. We could be doing a lot more about fixing that, rather than worrying about this whole, like, narrative around where's the price going. Like, I just think it's kind of irrelevant.
I mean, frankly, the good news in the industry is, and I don't want to sound like an ESG type, the good news in the industry is that there are more people that look like you and fewer people that look like me. There are people from around the world coming into the industry. They say there's a shortage of talent in the mining industry. No, there's a shortage of old white talent, and that's dying out. And that's a good thing. There's more women in the industry. The idea that we could ignore the intellectual inputs of half of humankind is really phenomenally stupid. But there's some bad things. The industry has been taught some very bad habits. The 1970s taught investors that what they should look for is optionality in commodity prices rather than efficiency in production. And that was a very, very, very back-asswards lesson. The investors, there was a wonderful cleansing that we experienced in the 1980s. I was more principally involved in the oil and gas business then. And the decline in the oil price from $30 a barrel to $10 a barrel made people for a while much, much, much better explorers and much, much, much better producers. The lame, the halt, and the blind that had populated the industry towards the end of the decade of the 70s went back to selling cars or whatever it was that they should have been doing, and took them out of the oil business. There was a real cleansing of the gene pool that took place in bear markets. And ultimately, I think the cleansing of the gene pool that happened among the producers in the last decade has made them, as an example, much more prudent allocators of capital today. How long that will last is a different question, of course.
That's right. I mean, like, the capital allocation in kind of the 2005 to 2010 boom, was ridiculous. Like, and I think, like, we've had someone on the show that kind of made the comment that, it's always interesting when like say acquisition behavior comes around and booms, because how often do you see ice cream salesmen buying ice cream trucks at the start of winter?
Right.
Like, and it's like, but so we seem to do that a lot at times, and you go,
Right.
well, and then do we wonder why we have problems with like capital return when we're behaving in this way?
Correct.
And the other point that I think you made, which I quite like, and you kind of made it earlier as well, is around like technology. I think one of the pieces that I think it's really going to change, and maybe arguably the industry hasn't been as good at kind of utilizing it, is the democratization of technology will allow us or allow different people to be involved in the industry. That's not just our industry, but across the board. All right. You made the comment that it's going to be 6 people in a garage in Mumbai or Lagos or something, and you just have to look at things like the prevalence of telephone banking or any type of mobile banking in many African countries. Like they are far ahead of that curve, because the level of democratization they can get out of that technology is phenomenal. And I think maybe that's kind of the next revolution for us as well, is that well, why do we have to have people sitting in kind of a mining jurisdiction? Why can't we use the intellectual capital that's sitting on the other side of the world in a different way and utilize it in a different way?
I think that's completely true. I mean, almost every mineral deposit that's ever been discovered outcropped. We stumbled
Exactly.
over it.
Yep.
And we're going to have to do better exploring undercover and projecting geology. We're going to have to do that. I have no idea how we're going to do that. It's going to be people like you who figure that out. I'm, as an example, amazed at the advances that the exploration business has made using astroimagery. Doing photo differentiation from space in 2,000 kilometer blocks and ruling out 99% of the 2,000 kilometer block so that you can focus human activity in places where, as an example, there's alteration, where there's structure that's so big that it's mapped from space.
Yep.
The idea, as an example, that you could explore the Tethyan metallogenic belt, because astroimagery requires fairly sparse land cover in order to work well, that you could explore an enormously prospective belt of rocks that, as a consequence of sociology and politics, hasn't been explored with any technology more sophisticated than a pick and a mule. Tells me that when we get around to the convergence of technologies that Robert Friedland expresses so eloquently, that the future of exploration is very bright. It's just that we don't know how we're going to get. My generation doesn't know how we're going to get to that future at all. It involves technology we can't spell. It's going to be your generation that does that.
Yeah, and I think, I mean, the hard part is that we don't know the path yet. How do we get from here to there? And we don't know the time that it takes, like to get there. And I always kind of express it that, you knew that if you were 200 years ago, you knew that we were going to create some method of communicating that would allow us to communicate faster and connect and communicate with many people at the same time. But no one then could have predicted that we would have an iPhone. We knew that we would have a mechanism, but we just didn't know that we would have an iPhone. Or we would have social media or whatever it is. But instinctively, you can think that by human nature, we would have gotten to a point where we would want to communicate with as many people as possible, and we would try to grow our social network. And I think that's kind of the same in exploration. We know that we need to get there, but we're not quite sure which path are we going to take to get there, or how long it's going to kind of take.
Well, mercifully, there's enough entrepreneurs in the world that the big thinkers don't get to decide what the one path is.
Exactly.
It's useful if there's 1,000 points of light, none of which are muzzle flashes, meaning that exploration isn't driven by government, as an example, or maybe even driven by BHP or Rio Tinto.
That's right.
But rather that exploration, and maybe exploration is driven. It wouldn't hurt my feelings to see exploration partly driven by Bill Gates or Elon Musk. I remember 10 years ago, maybe longer, when Tesla was still in Santa Barbara, being asked by Tesla to give a discussion to them about rare earths and energy metals, and talking to the young people about Tesla, about the organization financial organization of the exploration business. And I remember saying, one of them saying, boy, if ever there was a disruptible business, he said, I've never heard of anything so antique and arcane as what you're describing to me.
And well, I mean, if you think about it, the current kind of financial structure that we have, to particularly fund exploration, and even to a large degree, I think, to fund mining as well. This is probably the worst system we could have in place, right? Like, the way that the different agents kind of interact, like we would have to try hard to probably have a worse system than we currently have in a lot of ways.
I'm not sure that's true. I'm sure that if exploration was funded by government, as an example.
That's true. Yeah, that would be an even bigger disaster.
Yeah, I mean, certainly, seeing the Russians snatch defeat from the jaws of victory around the world. But, actually seeing the lunacy of the U.S. government in the oil and gas business, it could be worse. It absolutely could be worse. Rather than allowing the private system to fail, we could allow government to fail wholesale.
Yeah, that's true.
That could happen.
Let's do it again. We'd love to have you, because we didn't talk about, like the whole jurisdictional risk. I want you to have that rant at some point as well.
Love to have that rant.
I'll put it here. You have a standing invitation to come on and rant with us at any time you want.
Great. Well, it'd be fun to do.
This episode of Exploration Radio was brought to you by Ahmad Salim and Steve Beresford, produced by Sean Jeffrey, edited by Ursula Anthony, and recorded remotely in February 2022. Exploration Radio is supported by the AIG, the Minerals Council of Australia, the Society of Economic Geologists, 121 Group, and the Assay. Until next time, let's keep exploring.